It's back. Big volatility back in the stock market after a quiet year to date in terms of volatility anyways. Big moves we've seen. Japan down 12%, NASDAQ in a correction, S&P 500 down around 8 or 9%. So what's going on? What was the catalyst? What did you do? And what's the best way to play when you get volatility like this? That's the topic of today's video. Hi everybody, I'm Jeff. Let's get into today's video where we're going to tackle the volatility over the last couple of weeks. There's been a few factors as to why, but most importantly, how have you reacted? That's the question. So one of the main factors that caused the stock market to get volatile over the last few weeks was the non-farm payrolls figure. For me, this was the biggest one that actually had the biggest impact on the market. Once this number came out on the first Friday of August, everything seemed to change immediately. So let's get into the non-farm payrolls first for anyone who's not aware what that is, and then we'll digest a little bit as to why that number had such a big impact on the stock market and caused it to sell off so much. So the non-farm payrolls figure, well, what is it? Well, it's really just a monthly figure that's produced out of the US. It's reported on the first Friday of every month around 8:30 a.m. Eastern Standard Time, that's New York time. And what it does, it looks at data from the previous month, how many new jobs were created, i.e. payrolls, in the economy, with some sectors removed, things like government jobs and of course farms as well, and military as well. So those are all removed, and they just produce a number for the number of new jobs created for the previous month. It's a really big number. Like I said, first Friday of the month it comes out, and it tends to have a really big impact on the US stock market. So it's definitely one to watch. Most traders and investors will keep an eye on that number because it gives a really good gauge to what's happening in the labor market and therefore what's happening in the economy. So what actually happened when the number came out on the first Friday of August? Well, basically, the number came in a little bit weaker than expected. So the number of new payrolls, new jobs added across the economy was less than economists had expected. And this caused people to start thinking the economy is starting to slow down, the Fed has kept interest rates too high for too long, and we're heading towards a recession. The other thing that came out in the non-farm payrolls that comes out every month when the number is released, the unemployment rate, and it ticked up a little bit up to 4.3%. So when you put that together with the softer job data, new payrolls, the psyche changed for the market overall, and that led to future selling off, the stock market started to sell off, and then that was the main catalyst for me as to why the market started to really go down. So why would one number all of a sudden come out on a Friday, slightly softer than expected, cause the stock market to sell off so violently? Frankly, the honest answer for me is it was a lot more psychological than fundamental. Even though the number was weaker, it was not so weak that it would be a big enough effect on the markets for me to really lead us to believe that we're heading into a recession. Think about it, it's one number, one data point. You look at the GDP numbers that came out for the second quarter, it came out better than expected at around 2.8%. That's a very strong growth number. It doesn't suggest a recession is in the horizon. Now, it's impossible to know for sure, but you have to take data point after data point and form a conclusion. And that's what economists tend to do. But unfortunately, in my view, the general consensus tends to be more on the negative side, particularly when it comes to economists. So the number came out weaker, markets sold off thinking we're headed to recession just based on the one number. But I also think there was more to the story than this, and a lot of it was just more technical. We've seen the markets run up an awful lot this year to date. Valuations have been getting stretched. Everyone's been talking about it. And in the month of August as well, you get a lot of people going away on vacation. Liquidity is lower. And all that means is there's a little less trading that's going on. There's less shares that are traded on a given day. And when you get lower liquidity and a market move, it can be exaggerated because there's just less liquidity in the market, less shares trading. So I think that was part of it as well. But ultimately, in my opinion, this was just more of a psychological event leading to some profit taking and the result of some low liquidity in August. The other part of this is it started the discussion around the Federal Reserve and their interest rates. Their interest rate policy, the Fed rate, is around 5.25%, and some people have been saying it's too high for too long. Inflation is coming down. It's getting closer to the 2% target for the Federal Reserve. So a lot of people think they should be cutting a little bit more aggressively here, because when you make a move on interest rates, it can take 6, 12, sometimes 18 months before that's felt through the economy. So the feeling now is that the Fed should start reducing rates quickly. They've been high for too long. They're behind the curve, as you would say. And this also played a little bit into this, because when people interpreted the weak jobs data, slowing economy, higher than normal interest rates, higher than perhaps they should be for a 4.3% unemployment, right? And inflation somewhere between 2 or 3, depending on the measure that you use. So maybe 5.25 is too high and the Fed is behind the curve. That induced a little bit of panic as well amongst investors. There's a third reason why the market may have sold off and been more volatile recently. And the media loves this one for some reason. Frankly, it's not that big of a deal. There have been plenty of videos around this thinking, the sky is falling, the world's going to crash, and Japan and the yen have had a huge impact on the US stock market. Let me explain a little bit. It's called the yen carry trade. Japan has been running ultra low interest rates for a long, long time. I'm talking decades now. And more recently, when other countries like the US, UK, EU have raised their interest rates, Japan has been much slower to do so. So the rates have remained very low. Now, what does that mean? Well, investors will go and borrow money in yen at a very low interest rate to borrow that money. They'll take that and then they'll reinvest it into assets that produce a higher return. Simple example, borrow yen, convert it to dollars and buy US treasuries, for example. And therefore you're going to make, if you're getting or paying 1% on the yen that you're borrowing and you're receiving 5% on the treasuries, well, therefore net is 4%. Creates another complexity as well. You get the movement between the dollar and the yen, and that factors into the returns. Lately, the last few years, the dollar's been very strong and the yen has been very weak. But the Bank of Japan has changed the dynamic completely when they started to raise rates recently. It strengthened the yen. It made borrowing that money more expensive, and therefore these investors started to think it's time to unwind this trade. Sell the assets we've invested in, convert it back into yen, pay back the debt, and we take our profits. And that is a big reason in particular why Japan sold off the Japanese stock market, because people would have borrowed money to invest in there, but also they borrowed that money, took it out and invested it in places like the US and the US stock market. And imagine if you borrowed money in yen, converted it into dollars, and bought the NASDAQ or bought Nvidia, the phenomenal returns you would have seen on that. So part of this is the unwinding of the so-called carry trade. That is a part of this volatility that we've had while that sells off. And this could go on for a little bit longer, no question about it. So a lot of people have been asking me, well, what should I do? Is the market going to crash? What's going to go on? At the end of the video, I'll put up a link to a video that I did recently on stock market crashes, so you can have a look at that, gets into it in more detail. But ultimately, you should not have done anything in this period of volatility. If you're asking that question, should I sell all my stock? Should I go to cash? What should I do? I'm afraid, I'm worried it's going to crash. Then you need to ask yourself a bigger question. Should I really be having this much money in the market? Because if you're having those feelings and those thoughts, in my view, you're over-invested. You've just got too much exposure to the stock market, more than you're ready for. So if I were you, I would consider maybe rebalancing a little bit, keeping a little bit more in cash, buying some bonds, something like that, just so you reduce your equity exposure. Because the last thing you want to do, if this market does go down another 10 or 20%, if you panic sell, it's going to be absolutely detrimental to your portfolio and the worst thing that you can do. So if you've taken action and you've been afraid over the last few weeks, then maybe you've just got too much exposure into the stock market. Otherwise, if you don't need the money and you think you can ride it out, absolutely it's the best thing to do. So what did I do when the markets were selling off over the last few weeks? Well, I logged in, frankly, and I placed a few buy orders. So as the S&P got closer to 10% down, it reached around 8 or 9 at the time I filmed this video, I placed some orders to buy. I got filled in a small account, but my main purchase that I wanted to do, a much bigger amount, is still not filled. And I calculated that purchase at exactly 10% below the recent high in July on the S&P. So hopefully that'll get filled over the next few weeks if the market sells off. But that's the only action that you really should be taking in my view. Logging in, placing some buy orders very calmly and trying to get filled because you're investing for the long term. Always want to be thinking long term with your investments. That's the way to do this. You should not be worrying or panic with some of these days of volatility like we've seen. It's just not a big deal. By the way, a lot of the buy and hold investors that I talk to people who've held Amazon, Microsoft, Apple for 20 years. They wish they had more cash available to buy some more. That's it. That's their only plan. Add some more money to their accounts if they can find it and buy some more stocks for the long term. So that's my video on the stock market, what's been happening with the recent volatility, the catalyst behind it being mainly non-farm payrolls. Ultimately, you shouldn't really be doing anything other than buying a little bit, nibbling away. I'm not saying go all in, and I'm certainly not saying come all out, that's for sure. But you've got to get the right mix for you in terms of stocks and cash. I hope you liked the video. If you did, why not give me a like, subscribe to my channels for more videos like this, share with a friend, leave me a comment, tell me what you thought of the video. Are we headed for a market crash? Are we not? I've got a video for you right here that you can look at in regards to the stock market crashes and all the definitions and everything else that you need to think about that. And I'll see you in the next one.